On this debate, and we've seen it very clearly articulated by the likes of Jeffrey Gundlach on one side saying, do you know what, we are facing recession, it's going to happen in weeks or months, there are going to be rate cuts as a result. And then BlackRock and Wei Li of BlackRock coming out saying, no, they're not going to resort the Fed to the old playbook. That debate is intense. How are the markets pricing this?
Look, I have a lot of sympathy for what Gundlach said yesterday. Many people who are pessimists about this regional banking crisis are claiming that, the situation doesn't end until the Fed cuts rates. The regional bank business model is coming under a lot of stress for that reason. They can't compete with money markets who are offering 4 to 5% yield. And the front end of the yield curve is very inverted. And the regional bank's business model is not very profitable if that stays. So until the Fed cuts rates, this situation is going to continue. Tightening of credit standards, which Powell and many of the Fed members warned us over the weekend that is coming and is going to hit economic growth. That's going to continue until the Fed cuts, and I think that's the prism through which Gundlach is seeing this situation.
We have Fed speakers later this week, and then the PCE index as well towards the end of the week. Look and pair that into how markets then could be positioning towards the end of this week and how those adjustments may come through. It's remarkable to think that some of the swaps markets are pricing 4.2% now by the end of the year.
Yeah, so I know we get PCE on Friday, but because we've gotten PPI and CPI, we have a good estimation of where it's going to come. I think a lot of the market attention is going to be elsewhere. We're going to be laser focused on things like lending surveys. What is the reaction function of these regional banks? Will they actually pull back on tightening, and to what extent? To that manner, we get the Senior Loan Officer Opinion Survey. It's done quarterly. We're going to get that survey before the Fed meets again. I think that is the risk that's going to cause the Fed to pause if those tightening of conditions come. But again, the Fed has told us many times they're going to attempt to keep rates high, and they're going to let the balance sheet expand as needed. And that is a very dire situation for the dollar, because if we get to a point in the later half of the year where the Fed is forced to cut rates to help the regional banking crisis, shall I say, the dollar is going to sink, gold is going to rise, real yields will go back into negative territory, and entrenched inflation, it could be here to stay, especially as the fiscal lever is back to stimulus already.